The biggest mistake people are making with these tax reforms isn't fear. It's misinformation. Because no, the tax authorities can't just debit your bank account regardless of your transaction narration, or the lack thereof. But that does not mean you're safe. So let's actually talk about what has changed with these tax reforms, what the tax authorities can and cannot do, and how to prepare yourself, your business, and your finances for taxation in 2026 the smart way. Hey guys, I'm Nneoma Grace, a corporate and tech lawyer, passionate about helping startups and founders just like yourself start, scale, and grow their businesses. And you cannot do any of those if you do not understand taxation and what your tax obligations are. But don't worry, that's why I'm here today, to fully break down the Nigerian tax reforms and how exactly you, as an individual, a content creator, an employee, a freelancer, a roadside vendor, an Instagram vendor, a startup, a fully fledged company, and everybody within the taxable income category can actually prepare for the tax reforms. What exactly changed, what the tax authorities can and cannot do, and how you can prepare yourself and your finances for taxation. So without further ado, let's get right into it, guys. I won't bore you with the many reasons Nigeria needed a tax overhaul, mismanagement of funds, overdependence on oil revenue, yada, yada, yada. Instead, I will go straight to the beginning of the conception of these tax reforms. And it started with the Presidential Committee on Fiscal Policy and Tax Reforms, led by Mr. Taiwo Oyedele. Now, this team was put together by the President of Nigeria, and together they came up with these reforms. Well, at the time they weren't called reforms, they were just bills. Now in October 2024, these bills were submitted, all four of them, they were submitted to the National Assembly, and after many deliberations, the readings, and all the due process had been followed, it was passed into law in 2025 to become effective, or to take effect from January 1st, 2026. Now, if you are in Nigeria or you are a Nigerian, you have heard the buzz around these tax reforms and how all sorts of information and misinformation has been flying around. So we're gonna just clarify some of those things now. These reforms are encapsulated in four legislations: the Nigerian Tax Act, the Nigerian Tax Administration Act, the Nigerian Revenue Service Establishment Act, and the Joint Revenue Board Establishment Act. Now, four of them together make up what everybody knows as the 2026 tax reforms. And together, they replace the old tax systems, consolidate the multiple scattered taxes that we previously had, and modernizes everything that we know about taxation, from corporate income tax to capital gains tax to stamp duties to value-added tax to personal income tax, and on it goes. Now, what exactly are these four individual acts, and why should you care about them? Well, the first one, which is the Nigerian Tax Act, consolidates all different kinds of taxes into one. Now, previously, we had a Corporate Income Tax Act, we had a Personal Income Tax Act, we had a Value-Added Tax Act, we had a Capital Gains Tax Act, and each of these independent taxes had their independent laws, and it became cumbersome for someone to literally go through all of the individual tax acts to figure out what exactly their compliance obligations were. So the fiscal team thought, well, why not consolidate all that into one law? So they made the Nigerian Tax Act, and this tax act combines every single taxation that we have now in Nigeria into one book, into one piece of legislation. So when you open that piece of legislation, you can see every single tax obligation that every Nigerian within the taxable income, or even those outside of it, really have. And so what this act did was it reduced duplication, it reduced the opportunities for tax evasion, because now you can't, or even tax avoidance, because now you can't say, oh wait, you didn't know these laws apply. You could just go to the one book and you find all of the laws inside. Now, the Nigerian Tax Administration Act is literally just as the name implies. It is the implementation for the Nigerian Tax Act. Now, all of these, the Nigerian Tax Act stipulates the taxes you're meant to pay, but the Tax Administration Act stipulates how you're going to pay those taxes and who regulates the payments, the receiving, the use of the funds that come in from taxation. Now, the Act, that's the Nigerian Tax Administration Act, also gives room for the creation of the Nigerian Revenue Service, which will replace the Federal Inland Revenue Service that we know and use in Nigeria. Now, the second or the third act in this four-piece of reforms is the Nigerian Revenue Service Establishment Act. Now, this act properly establishes the Nigerian Revenue Service, which, as I mentioned earlier, will replace the Federal Inland Revenue Service. It stipulates the body, who exactly, like which offices and which positions make up the body, what exactly their functions and their duties are, how they regulate taxation, basically all things to do with the body. Now, the fourth piece of legislation in these our four-pack tax reforms is the Joint Revenue Board Establishment Act. This one repeals and replaces the Joint Tax Board that we previously had and now introduces the Joint Revenue Board. It consolidates taxes across the federal, the state, and the local levels so that there is no double taxation across those levels. It even creates a central tax ombud so that citizens, the rights of citizens are protected in the sense that citizens can go to this tax ombud and make their complaints. If they do not want to go through the Tax Appeal Tribunal, they can go to the Tax Ombud, make their complaints, and the Tax Ombud is taxed or is given the powers to ensure that those complaints are resolved if the parties do not want to go formally through the Tax Appeal Tribunal. So in a snapshot, this is what the four acts do, or this is what they have been empowered, or they empower Nigerians, the tax authorities, and everyone captured within it to do. But what exactly are the changes that were made to the tax laws that enable us to call it a tax reform or an overhaul of the Nigerian tax system? Well, let's break it down. Starting from the very first one, which is, I know what everybody wants to hear, is the personal income tax. Now, personal income tax, as the name explains, is a tax on your personal income. Now, just to clarify, I know that this question has come up a lot, what exactly is the government taxing? Profit, revenue, income, gains, losses, this, that, yada, yada, yada. The government is taxing your income. As a person, it is taxing your income. The money that comes into you. That is what it is taxing. Not profits, not this, not the other one. It is taxing your income. Under this new law, the personal income tax still uses a graduated rating system. However, it has been designed or redesigned to make taxes fairer, especially for the low and middle income earners. And one of the most remarkable things about it is they have made it such that if you earn a minimum wage, which is 70,000 naira monthly, or you earn 800,000 naira or less annually, you are exempt from taxation. Now, if you earn from 800,000 and up till 3 million, you're subject to taxation of 15%. If you earn from 3 million all the way up to 12 million annually, you are subject to 18% personal income tax. If you earn from 12 million up until 25 million annually, you are subject to 21% and personal income tax. If you earn from 25 million up until 50 million naira annually, you will have to pay 23% personal income tax. Now, if you earn 50 million and above, yours is fixed at 25% personal income tax. Now, this is considered a major improvement when compared to the previous tax system, where even the first 300,000 naira that you make is subject to 7% personal income tax. But some people will argue, but again, compared to that, I think the margin from 300,000 to 800,000 is okay, even though the percent you are now meant to pay has significantly increased, or more like doubled. But what this has done, or at least what the increase in the amount has done, is it has protected low and middle income earners from paying these taxes when they are barely able to survive. Now, the second change that was brought in the realm of personal income tax is the introduction of rent relief allowance. Now, major studies show that one of the five things Nigerians spend the most amount of money on is housing, rent. And so the government has introduced the rent relief allowance, where you're able to claim 20% or up to a maximum of 500,000 in deductibles or in rent relief. But it's not actually automatic, just in case you're thinking, ooh, let me go and take 500k from the government or 20% of my rent from the government. No, for you to be able to claim this 20% or 500,000 naira rent relief, you must keep accurate records of the payment of the rent, and you must submit said receipts before you can even be accepted or before you can access this relief. And this is an extra step that the government took to avoid abuse of the system, and personally I agree. And no, this only applies to people that rent houses. If you actually own the home or you are a landlord in your own right, then you don't have access to, or this rent relief allowance is not applicable to you because you in fact own your home. There's also the Residency and Tax Basis, where under the personal income taxation, they have clearly defined who exactly will have to pay taxes in Nigeria, and that is Nigerians living in Nigeria, expatriates that are earning money in Nigeria or from Nigeria, and Nigerians in diaspora if and only if they earn income that is accrued from or derived in Nigeria, aka you are running a business and actually earning income from it in Nigeria or from Nigeria. It has also expanded what counts as taxable income beyond traditional income. Previously, only traditional income was taxable, that is income earned from salary. So things like content creation, crypto, and all incomes that come in from those non-traditional sources were left in a legal gray area. But under this new act, all of these sources of income have been pulled together into the taxable income category. So now if you earn income, whether you're a salary earner or you're a content creator or you trade in crypto or forex or whatever it is, as long as you make your money in Nigeria or you have a business that runs in Nigeria or makes money from Nigeria, you are within the taxable income category, and you will be obligated to pay taxes if you meet the criteria, aka if you earn 800,000 and above annually or more than the minimum wage monthly. Obviously, there were some other changes made to personal income tax, but these were the major ones. Now let's move into corporate income tax or company income tax. Under the Nigerian Tax Act, one of the major changes that was made to company income tax was in the expansion of the definition of a Nigerian company. Previously, only companies formally registered in Nigeria were considered Nigerian for the purposes of taxation. So if you were a foreign company that simply ran your operations here without actually registering, you were not necessarily captured into the tax net. But under this new law, every single company that is, first of all, formally registered in Nigeria, second of all, whose main operational decisions, whether it's your day-to-day running, your strategic planning and operations, your management, your financial decisions, etc., if there's so much has happened in Nigeria, you are now captured within the taxable net. The Act also simplifies company classifications. So not only did they broaden the definition of a Nigerian company, it also simplified the classification of companies. Now, previously or in previous laws, we saw that Nigerian companies were divided into three tiers. We had the small company, the medium company, and the large company, largely divided based on the revenue that they make in a year. Now, in this new act or in this new reform, it has been divided into only two: a small company and a large company. A small company is a company that earns at least 200 million naira in 100 million naira or less in revenue annually, or they have they have up to 250 million naira in fixed assets. Now, a large company is any company that makes anything above 100 million naira or has anything above 250 million naira in fixed assets. Now, with this categorization in these two different tiers, you find that small companies, aka those that have or earn 100 million naira or less in a year, or 250 million naira or less in fixed assets, are exempt from paying company income tax. They are also exempt from paying the 4% development levy. We will get to that in a minute. They are also exempt from paying capital gains tax and a bunch of other reliefs and exemptions that they enjoy. And again, this is designed or was designed to help small, mid, and medium-sized businesses to come up and to create a fairer environment for conducting business. Speaking of the development levy, this Nigerian Tax Act introduced a 4%, a flat rate of 4% to cover all the other scattered taxes and levies that were around. So we had the NRSEA levy, we had the NTAA levy, we had the tertiary education tax, and a whole bunch of these other tiny taxes that often tripped companies up because they were so tiny and so scattered. It was quite difficult actually to keep track of all of them. So this new tax act combines all of these taxes into one development levy, and it is only 4% of the annual turnover that is being taxed. Under the corporate income tax for this Nigerian Tax Act, they also introduced the minimum effective tax of 15%. So let's say, for instance, you conduct business in other countries and your total tax obligation worldwide in all of your many multinational offices is less than 15%. Well, Nigeria now has the right to bump it up to 15% so that in total, your tax obligation on all of your companies will average at least 15%. So that is the minimum effective tax. Now, they did a bunch of other things like the introduction of the controlled foreign business, the controlled foreign corporation rules, which basically targets Nigerian companies, well, not Nigerian companies specifically, but multinationals that try to shift their tax obligations to countries outside of Nigeria so that they don't have to pay Nigerian taxes. Well, the government can still hold you liable to pay those taxes that are due for you to pay in Nigeria through the controlled foreign corporation rules. The act also changes how capital allowances are handled. So companies can now use the straight line method to write off purchase of manufacturing equipment, plants, etc. And if the company earns taxable or non-taxable income, the capital allowances are prorated, but only if the non-taxable income is at least 10% of all of the income that you make. All of these provisions, I mean, there's so many more again, but these provisions at least make it easier for companies to conduct business in Nigeria. But finally, and most importantly for company income tax under the Tax Administration Act, it also simplifies what deductibles and deductions you are entitled to have. So anything or any expense that helped you to achieve the revenue that you ended up getting at the end of the year is and will count as a deductible. So for instance, staff salaries is a deductible, pension schemes, NHIS, health insurance schemes, all of that counts as deductibles. Rent for your office space is a deductible. So the only way that you can actually claim these deductibles is, again, by keeping proper receipts and records of the expenses that you made throughout the year. Now that we understand the crux of the changes that happen with personal income tax, the crux of the changes that happen with companies income tax, what else changed? Well, there's still a bit more things that changed. For instance, capital gains tax, which we are about to get to. Then there's also VAT, which personally I love. Then there are also stamp duties and all the other indirect taxes, which we'll get to in a minute. But for now, let's cover capital gains tax. One big change with capital gains tax is that they now harmonized it with personal and corporate income tax. Well, previously it was at a fixed rate of 10%, regardless of whether you're a company, regardless of whether you're an individual, regardless of whatever it is that you sold, as long as it was eligible to be deducted as or to be counted for capital gains, you were deducted the 10%. But now capital gains has been harmonized with corporate and personal income tax, which can be good and it can be bad, because if you are a small company, then obviously you are exempt from paying capital gains. But if you are a large company, then you will have to pay capital gains in the percentage that your company income tax is. If you are an individual that sells an asset that, capital gains tax will be deducted from. If you earn 800,000 and below, obviously you won't pay it. If you earn 3 million naira and above, then you will pay capital gains tax in the percentage that your personal income also is. So if you earn above 50 million naira and you transacted with something and you're meant to pay capital gains on it, well then guess what? You're paying 25% capital gains on whatever it is that you bought or sold. The act also expands what qualifies for capital gains to include digital or virtual assets such as cryptocurrencies, NFTs, and so on and so forth. This is indirect recognition of how people are creating wealth and making money in this day and age. And when it comes to shares and other assets, of course, there are capital gains taxes. And the definition for that has also been widened to include even shares that are sold in foreign currencies. So you see, to properly understand what assets qualify as or for capital gains and those that you can have reliefs on, you need to have a proper understanding of the laws, number one. Number two, you need to keep adequate records so that when you're filing or doing your assessment at the end of the year, typically or before March 31st of the following year, you would know exactly what reliefs you're meant to claim, exactly what taxes you're meant to pay on what. VAT, stamp duties, and other indirect taxes were not left out. And like I mentioned earlier, VAT is actually my favorite because I kind of like what they did with VAT in this new act or in the new law. As we all know, VAT is a consumption tax. And one of the biggest improvements that was done under these new reforms is the separation of VATable expenses from non-VATable expenses. Now, how did they come, to make this distinction? They did a research on the things Nigerians spend the most amount of money on. And they realized that it was 5 categories. Nigerians spent the most amount of money on food, on education, on health, on transportation, and on housing or rent, which is, basically housing. And so they said, okay, instead of making these 5 categories or things in these 5 categories tax exempt, let's make them 0 rated instead. 0 rated. And what is tax exemption? 0 rated is a 0% tax attached to whatever goods or services are sold. And 0 rated or 0 rate taxation differs from tax exemption because where in tax exemption the thing is only there is no tax on it for the final consumer only, and even though the businesses paid value-added taxes to purchase or to add up to the cost of producing whatever it is, they cannot reclaim the value-added taxes paid on that thing. But with 0 rated, it is not only is it tax exempt to the final consumer, aka they're not paying any taxes on it, the businesses that spent money acquiring the machinery or the equipment needed to produce that thing will also be able to reclaim the value-added taxes that they paid on it. Let me give you a very practical example. Now let's take bread, for instance. Bread is a basic food, and it's one of the things, it's in the category of food, and food is one of the things Nigerians spend the most amount of money on. Now, when a baker makes bread and sells bread, the final consumer, because it's 0 rated, the final consumer will not pay any value-added tax on the final bread. That is the bread itself, not the flour, the sugar, and all the other ingredients. The bread itself, baked and sold. The final consumer will not pay any taxes, any value-added tax on that bread. But think about it. The baker or the producer of that bread had to have bought an oven. She had to have bought electricity. They had to have bought a house, rented a place to produce that bread. All of these individual tiny pieces that come together to make up the final bread probably had value-added taxes on them. Now, with 0 rated or with 0 rate taxation, which is what has been introduced in the VAT system in Nigeria now, the baker or the producer of that bread is now entitled to reclaim all of the value-added taxes paid on the pieces of equipment or all the other factors that made up the bread. So she or he can reclaim the taxes, the value-added taxes on the oven, the value-added taxes that they paid on maybe electricity, the value-added taxes they paid on the rent, which I don't think rent is I don't think rent has VAT, but anyways, that's an aside. The value-added taxes paid on the purchase of the flour, on the purchase of the sugar, and etc. He or she is eligible to be refunded, 100% refund by the government, provided again provided that you have adequate records of all of these purchases and you can actually prove that you made these purchases. And you do it within 5 years, you are entitled to 100% refund of all of the value-added taxes that you paid on these items for production that you used to produce the bread. And this zero-rated tax system under value-added taxes under the new law is cutting across the 5 major areas Nigerians spend the most amount of money on. So that includes your rent, that includes your education, that includes transportation, that includes your health, and that includes food. Now, another distinction, there's a difference between raw food and cooked food. Now, when you go to the market and you buy raw food in the market, you're not supposed to pay VAT on it because it's zero rated. However, if you go to a restaurant and you want to buy food at a restaurant, it will carry value-added taxes. It will carry it because now they are treating that food as a business. And I know when I first heard it, it didn't quite make much sense to me because I'm like, well, that's the same example as the bread. So how come the bread is zero rated and the cooked food in the restaurant is not? But for whatever reason, it's not. Because now it's cooked food. So the taxation or the taxability of that food for VAT will be dependent on the turnover of the restaurant itself, whether it's a business or it's an individual that owns it. Because apparently, according to the taxman, the idea is if you earn more, you pay more taxes. So yeah, that's one of the very beautiful things that they did with VAT, which personally I kind of like. They also introduced tax credits. So for service-based businesses like accountants and lawyers and all other service-based businesses, you are now entitled to tax credits, well, VAT credits. But again, to be able to claim these incentives, you have to keep accurate record of it so that the government can actually certify that you are actually entitled to the tax credits that you say you want. Another major update besides the tax credits and the zero-rated tax system that they have done with the VAT is the introduction of a digital VAT compliance. So now businesses can now use or should now use electronic invoicing or accounting softwares. The government created an electronic fiscal system, EFS, I think, so that businesses can directly remit their VAT obligations to the government directly. And it's supposed to reduce errors, prevent non-compliance, and generally help us with honesty. Finally, the Nigerian Tax Act clarifies or makes easier the payment of stamp duties. So now stamp duties must be paid within 30 days. I think it still retains the 7.5% rate. And anybody benefiting from a transaction, whether that is a loan agreement, if the loan agreement is for 12 months and above, if it's less than 12 months, you don't have to pay stamp duty on it. If it's more than 12 months, you should most definitely pay stamp duty on it. But anyone benefiting from a transaction, whether that's a real estate transaction or any transaction really, must ensure that the document evidencing that transaction is stamped within 30 days. Now, these are the changes that were done under the Nigerian Tax Act alone. It's quite a lot, I know. It's quite a lot, I know. The Nigerian Tax Act, like I said earlier, consolidates all the many scattered pieces of taxation into one. So yes, naturally it will be bulky, but that's about the major changes that were done under the Nigerian Tax Act. Now, under the Nigerian Tax Administration Act, the Nigerian Revenue Service Act, and the Joint Revenue Board Establishment Act, what were the changes? I will just rush through those ones because they're not, well, there are many, but just so that this video is not an hour long, I will rush through those ones. Quickly, the Nigerian Tax Administration Act creates a unified framework for the administration of taxation across the federal, state, and local levels for companies, certain federal agencies, and non-residents who earn income from Nigeria. The Tax Administration Act also made it compulsory for all persons, companies captured within the tax net to register for a tax ID. So whether you're an individual, you must have your personal tax ID. If you're a company, you must have your personal tax ID. They also made it such that merely registering for a tax ID is not enough. You must register for a tax ID and actually file your annual self-assessment. Now, they introduced this thing called a self-assessment where you will go online, fill the form, even if you're an employee, fill in the form for your self-assessment, after which the tax authorities will then cross-check and issue you your tax demand notice, aka what you're supposed to pay in taxes for that annual period. And again, you must do the self-assessment before March 31st of the following year. So you know how we just ended 2025 now. You have to file your annual self-assessment before March 31st of 2026. But since the Tax Act comes into effect January 1st, 2026, you will now have to file your annual self-assessment before March 31st, 2027. The Tax Administration Act also replaces the Federal Inland Revenue Service with the Nigerian Revenue Service and broadens its duties and scope. Now, as a taxpayer, after you have registered for your tax ID and you have filed your annual self-assessment, the tax authorities have the power under this new law to conduct an ecosystem validation, aka cross-check that what you actually put in your self-assessment is actually correct. And if they find that it is wrong, or they find that there are discrepancies in what you put and in the reality of it, you will be called in to defend yourself or to explain the discrepancies and why they are there. Now, if you are unable to explain yourself, or you even refuse to explain yourself, the tax authorities can then undergo several due processes to ensure that, number one, those discrepancies are cleared up. Number two, you are reissued with a new demand notice. Now, this is if there are misstatements, if there is fraud, if you lied, or things like that. They would issue you a new demand notice for a new tax bill, which you are now meant to pay. And if you still refuse to pay, again, after due process has been followed, aka they take it to court, you do this, you do that, time has passed and they've given you opportunity to come for redress and blah, 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 and you have refused to do all that, or you have done all that and you have not paid the demand notice or the bill in the demand notice, then and only then are they allowed to substitute what you have to clear your tax bill. Because it's very, very important that I make this clarification. I've seen a lot online that says, oh my God, the tax authorities are going to reach into my bank account and debit my bank account. Nobody's going to do that, right? Nobody's going to do that unless there has been fraud, you have lied on your self-assessment, there has been several misstatements, and you have been called to defend yourself. You have even been issued a new demand notice, which, first of all, you can't defend yourself, you can't explain the discrepancies, or you just refuse to. And due process has been followed, aka this, many, they call you demand notice back and forth and and they've gone to court and you still have not paid your bills. Then and only then can they substitute what you have to pay for your tax liabilities. And how can they substitute what you have to pay for your tax liabilities? They can either sell an asset that you own. So if you own real estate, well, they can sell that to pay your tax liabilities. And yes, that and only that is when they can reach into your bank account and use the monies in your bank account to clear your tax liabilities. That is the only time. Again, emphasis, that is the only time they can actually debit your bank account. So please, guys, stop with the fear mongering and the misinformation and spreading all that around, okay? Let's not scare people unnecessarily. All right, I know you guys are smart. There are also much stricter penalties and interests for non-compliance under the Tax Administration Act. Now, if there are these discrepancies, there's fraud, misstatements, all that, and you have failed to or refused to, defend yourself and explain away the discrepancies, and they've given you a demand notice, that demand notice will obviously come with interest. You have to pay interest for your non-compliance. And so there are different penalties across different wrongdoings under the Tax Administration Act. There's quite a lot of them, so just for time I won't go into all of them. The Tax Administration Act also regularizes and tightens up the operations of the Tax Appeal Tribunal. So where before you go and it will take a considerably longer amount of time to get your tax appeal heard or to get your tax complaint resolved, they've been mandated, the tribunal has been mandated by virtue of this law to speed it up. Within 30 days or less, your complaint should have been heard, should have gone through due process, and should be out of there, so that they don't have such backlog of cases that have been unresolved from years and years and years past. Okay, they're trying to make the system a bit more efficient, and I applaud that. Then we have the Joint Revenue Board Establishment Act. I told you we're gonna run right through them. The Joint Revenue Establishment Act abolishes the Joint Tax Board and introduces the Joint Revenue Board, and consolidates all of the operations of the tax authorities across the federal, the state, and the local levels, so that there is no double taxation. And by double taxation, I mean so that you don't pay your taxes in your state of residence, and then in your state of origin they're asking you to pay your taxes again, or maybe the federal government is now asking you to pay taxes at the federal level, or maybe at the local level, so that things like that do not repeat themselves. It also created the Tax Ombud, which is a body that, just like the Tax Appeal Tribunal, can also handle complaints. So let's take, for instance, now you are a roadside vendor and someone is coming and charging you tax, all these tax collectors that come and collect cash from you guys. You can go to the Tax Ombud, or you can, amongst yourself, pick a representative, and the representative goes to the Tax Ombud and makes a complaint. Now, the Tax Ombud is mandated by the law to speedily rectify whatever it is whatever discrepancy is going on in the collection or the management of the taxes that are not in line with what the law says. The Tax Ombud has the powers and the authority to sort it out even before it reaches the Tax Appeal Tribunal, so that the weight on the Appeal Tribunal significantly reduces and only serious tax matters actually reach the Tax Appeal Tribunal. Much like the Joint Revenue Establishment Act, we also have the Nigerian Revenue Service Establishment Act that again establishes the Nigerian Revenue Service, which will take over from the Federal Inland Revenue Service. So there'll be no more Federal Inland Revenue Service. All we'll have now is the Nigerian Revenue Service. And again, they would take on same functions as the Federal Inland Revenue Service, only the scope has been broadened. Okay, now that we have extensively covered what exactly has changed, both in the duties of the tax authorities, in the taxes that we are meant to pay, in the timelines that we are meant to pay them in, and in the reliefs, exemptions, etc. that we enjoy from these taxes, how are you affected? Well, I mean, you already know how you're affected, but how can you prepare? How can you prepare your finances for taxation the smart way? And how exactly do these reforms affect you, affect your business, affect your annual filings, affect your finances, and affect the cost of living and everything that has to do with you? It affects in a bunch of other ways, because now you actually have to be more meticulous with your record keeping. But before we put the cart before the horse, what can individuals, if you're on it, because this is broken down into the individual category and the companies, so what can individuals expect from this new tax dispensation? Well, the first one is that you now have to get a tax ID. If you're an individual, that's non-negotiable. You have to have a tax ID. And it's not enough to have a tax ID. You must have a tax ID and file your annual self-assessment on or before 31st March of the following year. And as much as you're able, please be truthful about it, okay? Just so that you don't enter into an unnecessary back and forth with the taxman. Try and be truthful in it, okay? You must file your annual self-assessment. And now I know, I'm like, okay, but what if, Nneoma, I earn less than 800,000? Do I still have to file, the self-assessment? I'm tax exempt. Girl, file it. You have to file your annual self-assessment, and you have to get a tax clearance. Even if you are tax exempt, even if you are not within the taxable income net, you still have to file it and let it show nil. It's better that it shows nil than you don't even file at all. Just so that when the records come up, you don't have patches in your years or in the timelines, so that you can see, it's traceable across the years. So yeah, file it is very, very important. There is also enhanced verification processes by the taxman, just so that people don't get away with either imputing the wrong information or not even imputing the information at all. The taxman has been emboldened to undertake various and in-depth verification processes to make sure that number one, you file, number two, what you file is actually true and accurate. You must declare all your sources of income. Now, I know we're in Nigeria and we are entrepreneurial by nature, and so we have many different sources of income. You must declare all of them. So if you earn from content creation, you earn from a salary, you earn from a side hustle, you have a business, you have a tech product you're building, declare them all, okay? The taxman wants to know where your money is coming from. You now need tax clearance for loans and government grants and even certain scholarships and even visa. All of you that want to jackpot, you need tax clearance for things like that. So if you didn't have a reason to file your annual self-assessment before, now you do, okay? Because truth be told, that era of, nobody's checking me, I can get away with it, that era is long gone. It's all the way back in 2025, right? It's long gone. So everybody is on their toes now with this tax administration and with these tax reforms. And I know, again, there was a debate at some point going on that, oh my God, if I'm sending money to anybody, I must put in the transaction. And you were seeing things as ridiculous as 900,000 for Amala, and someone sent another money for gift. The taxman is checking all of this. Well, truthfully, it's impossible for the taxman to check every single citizen of Nigeria every single time, all the time. It's impossible. But just so that you don't make a mistake, and the day you make the mistake is the day they finally want to check and you are the scapegoat, just be on the safe side, okay? It's easier to be on the safe side than to not be on the safe side. So now that we've addressed individuals, companies, don't worry, I didn't forget about you. Now that we've addressed individuals, what should companies and startups and founders and business owners expect for their companies from this new tax dispensation? The very first thing is regularize your business. If you're a roadside seller and you don't have a registered corporate entity and you are just selling on whims alone, that counts as personal income and you'll be taxed on it. I hope you know. So if you fall into that category, please, for your own benefit, regularize and register your business under the appropriate class. Get yourself a tax ID as a company. Get yourself a tax ID and open a bank account. Don't mix personal income with business income. And this applies to individuals too. Don't mix personal income with business income. Separate them, just so that your financial books, your accounting, and your reconciliation of these monies and transactions is significantly easier, so that you can know what exactly is income that is coming to you for your personal use and what is income that you're supposed to use for a client or as a cost of producing whatever it is that you do. Keep proper records. Properly calculate your value-added taxes and withholding tax obligations. Once you properly calculate them, then remit them on time. Okay, so that you can now have eligibility, or you can now be eligible to claim the reliefs where there are. Understand capital gains and their applicability. Track the sales and the purchase of assets so that you know where capital gains is applicable and where it is not, so that you don't overpay your taxes or underpay your taxes. Now, another thing, I don't know if I mentioned it, but if you overpay your taxes under this new administration, you can actually get a refund. Now, that's what they said. I don't know that anyone has actually applied. Well, it just came into effect, so let's not. By next year, we'll assess whether or not someone can actually get a refund and how quick you can get a refund. But under the new act, it is said that if you overpay your taxes, you can indeed get a refund. So that is still to be seen. Integrate your accounting into digital platforms or softwares so that your accounting is easier for you. 1, 2, so that you can get your accounting or your financial books or your invoices or your list of transactions, whatever it is, so that you can get them in real time too. So that if you're being asked questions, it's easy for you to just press something on your phone and pull it up. Okay? The days of moving papers around they're long gone. Okay? Digitize yourself. Maintain proper payroll. Even if you're the only employee in your company, even if you guys are only 2, maintain proper payroll. Okay? Not just payroll. If you pay pensions, note that down. If you pay NHIS for yourself, note that down. If you pay any other sort of thing that can be calculated as a deductible, note it down. Last but not least, for companies, keep proper records. I think I've mentioned this before. Keep proper records and audit yourself as a company periodically. Okay? Don't let it go for like 5 years before you conduct an audit. Audit yourself periodically so that you are sure that if you are called upon, you can easily produce your financial statements and your books and everything will be in tip-top shape. And not only for the tax purposes, even for investors, when you have your financial books properly recorded and audited, it kind of makes you look better than your competitors. So, has multiple benefits. So, as you can clearly see, guys, the tax reforms were not meant to punish Nigerians, unlike people that are fear-mongering out there. It's for all I've seen thus far, it is quite fair, right? And for all of you that are arguing, well, the tax reforms only give me obligations, there are no reliefs in the tax. All 4 of the act, there are at least 50 reforms and incentives, at least 50 of them. And for time, I will only list about like 5, right? And which is, again, the individuals earning minimum wage are tax exempt, small companies are tax exempt, you know that already. There's also the rent relief. You have rent relief of 20% or up to a maximum of 500,000 naira on your rent. Investors in Nigerian labeled startups actually enjoy tax exempt, or they are tax exempt from capital gains when they sell the assets that they've gotten from their investment in that Nigerian company. And there are so many more. I mean, I did a 4-part series on the tax reforms on my Substack. The link is in the description below. If you want a more in-depth and a fuller look into the tax reforms, all 4 of the laws, what changed, how you can prepare for it, smart legal strategies that you can use, even all 50 of the reliefs, then please, by all means, click the link below for the Substack articles and go read each and every one of them. They are very, very in-depth, and over 1,500 people already find it very, very useful. And you never know, you might be one of them. So please go read it. And yeah, also, guys, I think, is that the end? So yeah, that is the big picture. So yeah, that is the big picture with the 2026 Nigerian tax reforms. Whew, girl, I'm parched. I need water because it's been a lot. Anyways, that is the big picture, and those are the taxes that apply, to whom they apply, how you can prepare for them so that you can take advantage of all the benefits that it offers and you will not be caught on the other end of it, right? That is it. If you found this video helpful, if you watched it till now, thank you so much for sticking around and watching it to the very end. And if you found this video helpful, please hit the like button below so that this video can be shared to many amazing people such as yourself who will find it helpful as well. Please like this video, and I will see you in the next one. Bye.